Most people assume financial systems fail when money runs out. But in many critical cases, systems don't collapse because assets vanish. They fail because the essential flow of liquidity disappears. Homes, businesses, and investments still exist, yet suddenly, they cannot be sold, financed, or moved. When this happens, markets don't slowly adjust, they freeze. Understanding liquidity explains why these periods of stress often feel sudden, confusing, and disproportionate, offering a crucial lens for investors, analysts, and the general public alike. By the end of this video, you will grasp the fundamental concept of liquidity, distinguish it clearly from solvency, and understand why liquidity, more than fleeting headlines or speculative predictions, is the true determinant of whether financial systems operate smoothly or succumb to stress. This isn't about forecasting market movements or instilling fear. Instead, it's designed to equip you with a calmer, more accurate analytical framework for comprehending how financial systems behave, especially during times of uncertainty. This knowledge is vital for informed decision-making in investment, risk management, and policy understanding. Liquidity, in its essence, refers to the ease and speed with which an asset can be converted into usable cash without significantly impacting its market price. It's about access to immediate purchasing power or the ability to meet short-term obligations. This concept is foundational for financial education, as it underpins the functionality of all markets. An asset is considered highly liquid if it can be sold quickly, at a reasonable price reflecting its intrinsic value, and readily used as collateral for borrowing. Cash itself is the ultimate liquid asset, instantly convertible and universally accepted. Publicly traded stocks are generally liquid, given active markets and numerous buyers and sellers. Conversely, real estate, while valuable, is typically less liquid due to the time and effort required for transactions. Specialized assets, such as unique art pieces or private equity stakes, are often illiquid, demanding significant time and effort to find a buyer. For investors, understanding an asset's liquidity profile is crucial for portfolio construction and risk management. Liquidity is not synonymous with value. A highly valuable asset can be profoundly illiquid if there's no immediate market for it. It is fundamentally about the ease of access to capital and the ability to transact without friction. This distinction is paramount for analysts assessing market efficiency and for policymakers designing financial regulations. This distinction is absolutely critical for anyone seeking to understand financial stability and risk. Solvency addresses the long-term health of an entity, asking, are total assets greater than total liabilities? A solvent entity possesses more value than it owes, suggesting long-term viability. Liquidity, however, focuses on immediate capacity, asking, can current obligations be met right now with readily available funds? An entity can be perfectly solvent, holding vast amounts of valuable assets, yet be completely illiquid if those assets cannot be quickly converted into cash to pay immediate bills. This scenario is a common precursor to financial crises. Consider a company owning valuable factories and intellectual property, solvent, but lacking the cash to pay its employees or suppliers next week, illiquid. Or a bank with a strong loan book, solvent, but insufficient reserves to meet sudden depositor withdrawals, illiquid. In these moments, assets still exist, and long-term value may remain intact, but short-term obligations cannot be met. Most financial stress events, from individual firm failures to systemic crises, begin as liquidity problems, not solvency problems. The inability to access cash quickly can force the sale of assets at fire sale prices, eroding solvency over time. For investors, discerning between these two states is vital for assessing true risk. For policymakers, it guides interventions aimed at preventing illiquidity from spiraling into insolvency. Liquidity is the lifeblood of the financial system, flowing through intricate channels that connect banks, financial markets, and credit networks. Its movement depends critically on confidence, the willingness of participants to lend and borrow, and the robust functioning of market infrastructure. Understanding these flows is essential for financial education and investment analysis. Banks act as primary conduits, lending to businesses and individuals, and borrowing from each other in interbank markets. Financial markets, including bond and equity markets, facilitate the exchange of assets for cash, providing avenues for liquidity creation and absorption. Credit channels, encompassing everything from corporate bonds to consumer loans, distribute liquidity throughout the real economy. When liquidity flows freely, transactions clear efficiently, credit remains accessible and affordable, and market volatility stays contained. This smooth operation fosters economic growth and stability. Investors can easily buy and sell assets, and businesses can secure funding for expansion. However, when confidence erodes or market plumbing becomes clogged, liquidity tightens. Interbank lending may seize up, credit becomes restrictive and expensive, and stress becomes visibly apparent across asset classes. This tightening can be triggered by various factors, from economic uncertainty to regulatory changes, and its impact can quickly cascade through the interconnected global financial system. Policymakers constantly monitor these flows, as disruptions can signal impending systemic risk. Liquidity rarely captures public attention during periods of stability. Markets function smoothly, payments clear without delay, and asset prices move gradually, reflecting underlying fundamentals. Because liquidity operates so quietly and efficiently in normal times, its presence is often taken for granted, assumed to be a permanent fixture of the financial landscape. This invisibility makes its sudden disappearance all the more jarring. However, liquidity is not an immutable physical constant. It is a behavioral phenomenon, deeply intertwined with trust and confidence. It depends on the collective willingness of market participants to lend, borrow, and transact. When uncertainty rises, whether due to economic shocks, political instability, or unforeseen events, this collective behavior shifts dramatically. Lenders become cautious, hoarding cash rather than extending credit. Buyers step back from markets, fearing further price declines or an inability to resell assets. Risk tolerance shrinks across the board. Liquidity doesn't vanish instantly. Rather, it withdraws, like a tide receding from the shore. This withdrawal can be subtle at first, manifesting as slightly wider bid-ask spreads or reduced trading volumes, before escalating into a full-blown market freeze. Understanding this behavioral dynamic is crucial for investors navigating volatile periods and for analysts assessing systemic risk. When liquidity tightens, the financial system experiences a series of predictable, yet often severe, mechanical consequences. These effects are critical for investors to understand, as they directly impact asset prices, portfolio performance, and overall market stability. The most immediate signs include a widening of bid-ask spreads, meaning a larger gap between the price buyers are willing to pay and sellers are willing to accept. This increased friction makes transactions more costly and difficult. Asset prices can gap downwards, experiencing sharp, sudden drops as sellers desperate for cash are forced to accept lower bids in illiquid markets. Volatility increases dramatically, as small trades can have outsized impacts on prices due to a lack of market depth. This environment makes it challenging for investors to execute trades at desired prices and for analysts to accurately value assets. Importantly, this tightening does not necessarily require widespread panic or irrational behavior. It can occur simply because balance sheets across the system become stretched, funding costs for financial institutions rise, or risk management frameworks become stricter in response to perceived threats. For instance, banks might increase collateral requirements or reduce lending limits. Liquidity tightening is often a mechanical response to changing financial conditions rather than an emotional one. It reflects a systemic reevaluation of risk and the cost of capital. For portfolio managers, this means a potential liquidity discount on assets that were previously considered easily tradable. Understanding these mechanics is vital for risk management and for interpreting market signals during periods of stress. History provides invaluable lessons on the critical role of liquidity in financial stability. Numerous financial disruptions throughout history have followed a remarkably consistent pattern. Liquidity tightens, markets seize, and eventually, intervention restores the flow. Analyzing these historical events is a cornerstone of financial education and risk management. Consider the Panic of 1907, where a lack of liquidity in the New York money market led to a widespread bank run and a severe economic contraction. J.P. Morgan's private intervention, essentially acting as a lender of last resort, stemmed the tide. More recently, the 2008 global financial crisis saw interbank lending freeze completely as institutions lost trust and hoarded cash. This liquidity crunch, initially affecting mortgage-backed securities, quickly spread, threatening the entire financial system. In many of these cases, the long-term value of underlying assets remained or eventually recovered. Systems adjusted, often with significant government and central bank intervention, and economic activity eventually resumed. The key takeaway is that while the immediate impact of a liquidity crisis can be devastating, it often represents a temporary dislocation rather than a permanent destruction of wealth. Understanding this historical pattern helps investors and the general public reduce alarm when volatility appears. It highlights the importance of central banks as providers of emergency liquidity and the role of robust regulatory frameworks in preventing future crises. For analysts, studying these events offers insights into early warning signs and effective policy responses. Modern financial systems are characterized by unprecedented speed, intricate interconnectedness, and often significant leverage. These attributes make liquidity an even more critical factor for stability than in previous eras. Understanding these dynamics is essential for contemporary financial education and policy understanding. The advent of high-frequency trading and global electronic markets means that information, and consequently, liquidity shifts, can travel across borders and asset classes almost instantaneously. Small disruptions in one corner of the market can rapidly propagate through complex derivatives chains and interbank linkages, creating systemic risk. This interconnectedness means that a liquidity squeeze in one market can quickly trigger a flight to quality or a dash for cash globally. Furthermore, the widespread use of leverage, borrowed money to amplify returns, exacerbates liquidity risks. When asset values decline, leveraged positions can face margin calls, forcing distressed sales that further depress prices and drain liquidity. This creates dangerous feedback loops that can accelerate market downturns. This modern landscape does not necessarily imply inherent fragility, but rather heightened sensitivity. The system is more responsive to shocks, both positive and negative. This sensitivity necessitates constant vigilance from regulators and central banks, who employ sophisticated tools to monitor liquidity conditions and intervene when necessary. For investors, it underscores the need for robust risk management strategies that account for rapid shifts in market liquidity. Several common misunderstandings about liquidity can lead to flawed financial analysis and poor investment decisions. One prevalent misconception is believing that liquidity only matters to banks or large financial institutions. In reality, liquidity profoundly affects every aspect of the economy. A lack of liquidity can cripple small businesses unable to secure short-term loans, leading to job losses. It can impact consumer spending if credit markets tighten, and it directly influences investment decisions across all sectors. Market pricing for everything from commodities to real estate is influenced by the ease with which assets can be bought and sold. Ultimately, economic confidence, a crucial driver of growth, can be severely undermined by perceived liquidity shortages. Another significant misunderstanding is assuming that liquidity problems automatically equate to permanent loss or insolvency. While a severe liquidity crunch can certainly push a solvent entity into insolvency, historical evidence suggests that liquidity stress is often temporary. It can be intensely uncomfortable and cause significant short-term pain, but with appropriate intervention and time, markets can regain their footing. For investors, this means distinguishing between a temporary market freeze due to illiquidity and a fundamental impairment of asset value. For policymakers, it highlights the importance of providing temporary liquidity support to prevent a solvable problem from becoming a catastrophic one. Dispelling these myths is crucial for a more nuanced understanding of financial markets and effective risk management. Liquidity is not merely a characteristic of assets. It is the fundamental enabler of credit, and credit, in turn, supports the vast edifice of global debt. Understanding this core relationship is paramount for financial education, investment analysis, and comprehending systemic risk. Credit, the ability to borrow money, relies entirely on the availability of liquidity. Lenders must have sufficient liquid funds to extend loans, and they must be confident that those funds will be repaid or that the collateral can be easily liquidated if necessary. When liquidity is abundant, credit is readily available and often cheaper, fueling economic activity and investment. Conversely, when liquidity tightens, the credit tap begins to close. Lenders become more risk-averse, demanding higher interest rates, stricter collateral, or simply refusing to lend. This contraction of credit makes it significantly harder for businesses to finance operations, for consumers to make purchases, and for governments to manage their debt. Debt, whether corporate, household, or sovereign, becomes particularly vulnerable during liquidity crunches. Existing debt may need to be refinanced, but if credit is scarce, borrowers can face default even if they are fundamentally solvent. This is why liquidity often sits at the very center of financial stress events, acting as the critical link between market function and economic stability. Understanding this intricate connection provides a complete system view, essential for any serious financial analysis. You don't need to monitor daily liquidity metrics to benefit from this knowledge. However, understanding the concept of liquidity provides an invaluable framework for interpreting complex financial events. It helps explain sudden, seemingly irrational market moves, the rationale behind central bank policy responses, and why periods of stress often appear before any negative headlines fully materialize. This clarity is crucial because it helps reduce emotional reactions during times of market turbulence. When you understand that a market freeze might be a liquidity issue rather than an immediate solvency crisis, your perspective shifts. You can differentiate between temporary dislocations and fundamental impairments. Emotional reactions, driven by fear or panic, are rarely helpful during transitions or periods of uncertainty, often leading to suboptimal investment decisions. By grasping the mechanics of liquidity, you gain a more objective lens through which to view financial news and market behavior. This analytical approach empowers you to make more informed decisions, whether you are an individual investor managing your portfolio, an analyst assessing market risk, a student learning about financial systems, or a member of the general public seeking to understand the economic landscape. It fosters resilience and a more rational approach to financial challenges. In our next episode, we will bring these powerful ideas together. We will delve into how debt, credit, and liquidity actually work in concert as a single, interconnected system. This comprehensive view explains much of modern financial behavior, from economic booms to busts, and offers deeper insights into the mechanisms that drive global finance. You now understand that liquidity is not about an asset's inherent value. It is fundamentally about access and flow, the ease with which assets can be converted into cash. This crucial distinction explains why financial systems sometimes freeze, why market volatility can surge unexpectedly, and why stability depends on far more than just underlying economic fundamentals. With this robust framework, financial stress becomes significantly easier to interpret, less confusing, and, most importantly, less emotionally charged. This knowledge is your shield against panic and your guide to informed decision-making. If you found this video insightful or beneficial, please take a moment to like it. Your engagement truly encourages us to continue creating valuable content. Thank you for watching, and have a blessed day.